welcome to the firm. On the show this week, there's good news for the private equity industry. A tribunal decision specifies how trusts can still get pass-through tax status. And London is a hotbed of private action claims against cartels. Can Indian victims share in the gains? All right, let's get to our top story this week. Now, in July, a CBDT circular clarifying the taxation of alternate investment funds upset how the private equity industry structures its funds. And that's because the department clarified that PE funds structured as trusts must name the investors and their beneficial interest up front. Now, that's a tall order, as private equity funds have multiple closings, with investors coming in at different points in time. But now maybe there is a reprieve in sight. A recent Bangalore Tax Tribunal decision in the ICICI India Advantage Fund case said that funds structured as trusts can get a pass-through status for tax purposes. Payaswini Upadhyay has more on what this means for the private equity industry.
The Bangalore ITAT ruling for the first time deals with three important principles of trust taxation. 1. Revocability provisions and consequent tax implications. 2. When can a trust qualify as a determinate trust? And 3. Whether an investment fund is an association of persons subject to a higher tax rate.
The case pertains to the India Advantage Fund that was set up as a trust. The trust declared an income of 1.8 crore rupees and made a case before the tax department that the beneficiaries will offer the income for tax and not the trust. The assessing officer concluded that the trust was in the nature of a discretionary or non-determinate trust and hence taxable at maximum marginal rate of 30% at the trust level. The AO's order was reversed by CIT appeals, who held that since the trust was a revocable trust, it cannot be taxed at the trust level. The tax provisions for a revocable trust say that the income will be taxed at the hands of the contributor and not the trust. The tribunal upheld the view of CIT appeals on grounds that the trust deed gave the investors the power to revoke their contributions, and so the income earned by the trust is taxable only in the hands of the contributors.
Fortunately, the way if you look at the ruling, it says that any revocability within the document is good enough. So it need not be that 100% of the fund should be revocable. It need not be that one person can revoke it. Revocability in any form by any agency involved is good enough to make the trust or the fund revocable, and therefore the so-called pass-through benefit should be given in the hands of the beneficiaries.
The revocability principle assumes importance because if a trust doesn't permit revocability, it needs to qualify as a determinate trust to get a similar tax pass-through status. For a trust to be determinate, the names and individual shares of the beneficiaries should be spelled out on the date the trust deed is signed. If a trust doesn't pass these two tests, it is taxed at the maximum marginal rate of 30%. The cause of determinate trusts was helped by the 1996 AAR ruling in the matter of AIG. The AAR had ruled that the exact share of the beneficiaries need not be specified. Even if there is a predetermined formula by which distributions are made, the trust could still be considered a determinate trust. Well, this ruling prevailed till July this year, when the CBDT dropped a bombshell. The board issued a circular saying where the trust deed does not name the investors or specifies their exact beneficial interest, the entire income of the fund will be taxed at the maximum marginal rate of 30% plus surcharge.
First of all, everybody was surprised with that circular because that circular overrules a laid down position since 1996 under an AIR ruling in the AIG case as to what is taken to decide. So a particular thing is a discretionary trust or it's not a discretionary trust. That rule that has been overruled by this. The way people have been doing is, can we do one single closing rather than multiple closing where put all the names? Some people are trying that, but then again there will be the issue of transfers from one individual to another, and that would vitiate the whole thing. Some people are thinking, can we have an alternate structure which is not a trust, but say a limited liability partnership? That's one way of overcoming this. So this is why people are trying different structures, but I don't think anybody has come out with a perfect structure as yet.
There are two concepts in the Income Tax Act. One, straightforward revocability. Second, what is called dimmed revocability. So under the dim revocability, in the placement memorandum, for example, you provide that 75% of the investors can come together and dismiss the investment manager, blow up the trust and get back the money. So Tribunal has very wisely stated that there could be direct revocability, there could be indirect. But if you understand the industry, if you understand the business, then you will go more on a dimmed revocable provision rather than direct, because direct will cause a lot more problem to the manager and the other people involved.
By interpreting the revocability provisions in a wide manner, the ITAT has given the private equity industry an additional structure to work with. Additionally, it has also grandfathered trusts set up before the CBDT's July circular. The tribunal ruled that the maximum marginal rate will not apply to a trust even if it doesn't name all the beneficiaries. And since the circular came out after the India Advantage Fund was set up, it has no application.
I think the precedent value of this case will be more for the past. That means people who are having funds, who have exited or who have assessments going on for say 2007, 8, 9, 10, those years, which are similarly structured as IF, and I believe a lot of them are similarly structured. There will be definitely it has got a positive value. We still have to see whether the department is going to appeal the tribunal order in the High Court, which may also happen. So for them, there is a precedent value, but for the future, what is called structures are concerned, future exits are concerned, I doubt that one can derive too much of comfort from this.
The third principle in this ruling that has cheered the private equity industry is the way the tribunal has ruled on the concept of Association of Persons or AOP. In the case of India Advantage Fund and many such structures, the tax department has been alleging that the investment fund is an AOP. Once a fund gets classified as an AOP, it is taxable at the maximum marginal rate of 30% plus surcharge. Now, the tribunal has ruled that since the investors of India Advantage Fund made contributions to the trust under individual contribution agreements, it cannot qualify as an AOP.
If one look at the situation of fund where several contributories come together at an instance of an investment manager and then they are investing their funds and getting their gains, I don't think that gives a rise to a situation of AOP, because in AOP certain people come together on their own for a particular common objective, and there are common resources, there are common expenses, there are common gains to make, etc. In this situation, one investor may not even know the other investor, right? Because it's an investment manager who is getting all this activity together of investing and then passing on the gains. So I wouldn't say that all these investors have come together on their own volition to make investment activity. It is not like that, and therefore Bangalore Tribunal has rightfully concluded that this is not an AOP kind of situation, and therefore a maximum marginal rate of tax should not apply.
Taxation principles for revocable trusts, what makes a trust determinate, and what constitutes association of persons. Experts say the Bangalore Tribunal has taken a very wide and pragmatic view on three very important aspects of fund taxation. Some experts say that the ruling helps not just pre-CBDT circular structures but future ones too, as a circular is not binding on the taxpayers. And so the industry can continue to benefit from the favourable interpretations in the AAR's AIG and now the Bangalore Tribunal's ruling. Whether that view stands in court, we'll know once the CBDT's new circular is tested in the court. In Mumbai, Payaswini Upadhyay.
So that's good news for the private equity industry. On that note, let's take a quick break on the firm. Up next, London is a hotbed of private action claims against cartels. Can Indian victims share in the gains?